Our next guest argues that tech's recent drop is flashing warning signs for the overall market. Let's welcome in Jim Paulsen, the chief investment strategist for the Leuthold Group. Jim, good to have you back.
Thanks for having me, Scott.
Point of view plays right into our conversation. Do you think tech is in longer-term trouble than others may think?
Well, I do think I put out a piece there last week. If you look at what tech stocks are doing relative to utility stocks, tech in their own right are not up anywhere as close to what they did in the late 1999, for example, during the dot-com run. But relative to utilities, they are. They've both, recently in last year, the relative tech to utilities has gone hyperbolic, just what happened in the late 1990s. And I think it says something about the character and mindset of the players, of investors. For the first time, confidence has returned in this bull market. A bull market that was driven by a wall of worry is no longer there. Confidence has returned, and I think that shows up in it as people get confident. They start going more aggressive. They start going with what's working. They start going with the comfort of popularity, and they're all going into the same FANG stocks, the same technology stocks, and they're all avoiding all of the defensive worrywart stocks.
For a good reason, right? I mean, that's where the growth is. Go where the money is.
I think that tech is doing well fundamentally, but with the rate at which they're accelerating and the rate at which defensive stocks are underperforming, I think it looks more like the end of a confidence bull than it does anything like the beginning or more to go. I just think this market is vulnerable. It isn't really about trade. I think trade wouldn't have bothered this market last year, but this year with high valuations and contracting financial market liquidity and rising yields, and gone is the wall of worry, and potential profit margin erosion from rising inflation. I think all those are making this a vulnerable market, vulnerable to headline news.
Well, trade's made it the most vulnerable,
every headline that comes out makes it much more volatile than last year.
Jim, you had a narrative that was so positive for business. The economy was going to do nothing but go up. Earnings were going to do nothing but go straight up. And then all of a sudden you introduced volatility into that, headwinds into that potentially through tough talk about trade, whether it's with Canada, Mexico, and now, the big behemoth of being China.
I still think, Scott, that it certainly was a catalyst for what occurred, but it's not the reason it occurred. I think it was more the vulnerability. I think people are really focused on earnings this year, and I agree they're going to be great. They're going to be $150, $160 a share. The problem is we paid ourselves last year for those earnings. Earnings didn't do hardly anything last year, but the valuations went way up. And now that the earnings are going to come through, the problem is we already got paid for that. And so I think people are misinterpreting what's happening on Main Street. It's the best Main Street we've had in this whole recovery. But you got to remember this bull that was driven by the lack of Main Street doing well. It was driven by an awful Main Street and awful fundamentals. And now that they're back at full employment, I think we're going to get rate pressures and cost pressures and inflation pressures and at high valuations. There's just not the room left unless we have a refreshing pause or a correction.
Yeah, Josh?
Yeah, so Jim, you think about where the earnings growth came from. I think last year and a little bit of 16, we were lapping the oil plunge. And so you had this huge comeback in energy sector earnings, and that was a tailwind you don't have right now. And then when you think about this year, and I'm curious on your thoughts, you think about the size of Facebook, Google, Apple as a percentage of the indices, the stocks themselves, and then you think about their earnings increases or expected earnings increases, and then you look at what might put a damper on that. So, for example, if the FTC is looking at Facebook, Google gets dragged in. Think about Apple with the trade stuff. They have both sides of it. They need to manufacture there and they need to sell there in order to make their numbers. So is that really what we should be focused on, is the fact that tech earnings growth is now at risk in the estimates? Or is it too early to say that all of these issues surrounding trade and the FTC are going to weigh in on what's to come next quarter, the quarter after that?
I think it's too early for this year. I think these are important issues long term. I think regulation of technology and new era apps are hugely important long term, but I don't know if it's a big issue for 2018, nor do I think trade is. The three things I think are real risk factors for this year are a break to a new low in the U.S. dollar, and we're within a fraction of that DXY doing that even yet today, perhaps, or this week. If that happens, we're probably going to push crude oil and commodity prices, crude oil maybe above 70, and re-accelerate fears of inflation and higher yields. Secondly, I think those earnings numbers, and I get them, but I don't think they're predicated on any sense of margin erosion, which I think has a very good chance of happening yet this year. As wage costs head up over 3% and capital costs head up over 3%, we're going to see pressures on margin. That might cause Wall Street to lower earnings estimates yet. Secondly, this inflation fear could turn into stagflation fear. If you think about the tightening that we've put on the world, and particularly in the United States, with a flatter curve and much higher yields in the last 18 months, I think you could see the second half economy slow down. Not die, but if it slows down to 2.5% growth rather than 3%, I think some of those earnings estimates probably are going to be too high. If you have to revise down earnings, it's going to affect what the market can do this year.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.